Hey everyone, Lenny Brecken from Charlotte Consultant Services, and today I will be giving you an overview to actually forecast and model your business. Before we get started, one of the biggest mistakes done in small business is actually initially doing a business plan and a forecast, and then basically running your business day to day. A lot of business owners lose perspective on where they are and where they're going because they don't have a plan. And they start doing things like extending credit or levering up the business when they shouldn't be, and it negatively impacts their profitability. But not only that, but also puts the business at risk because they may be doing things at the tail end of a business cycle that was about to see a downturn. So I see more often than not, business owners don't maintain their business forecasts after they're up and running, thinking that it doesn't really hold that much value. And actually, uh, the primary reason you want to create a model for your business and forecast it is so you can optimize it. And so you can maximize its profitability, maximize return on investment that you're making, return on assets, and things like that. And that in turn maximizes the biggest asset you have, which is your business. And that business feeds into your personal income so you can create a financial plan for yourself. Your biggest asset, generally, if you're a small business owner, is your business, and you should maximize it just like you try and do your own personal investments if you have any. So the biggest mistake is not maintaining it, and as a result, the business isn't sort of optimized. Common mistakes by not maintaining a model is bidding on business that business owners shouldn't be because they don't understand the price components of their business, and they go out and bid business based on you know how much they if they have a book of business and they don't really need it, they charge a little bit more versus less if they don't have a big book of business. Or if in construction, what generally is done is they look at your house and say if it's a $1 million house, they charge more. And then that's basically how forecast use a forecast in their head to bid out jobs versus using a model which details the cost components and will lay out the bidding process so that you can actually make more educated guesses on what businesses you should pursue and what you shouldn't and how much you should charge. It also plans out your business for major expansions or contractions or hires and things like that, planning your cash flow accordingly so that you assure you have enough money down the road to make an expansion, and how much is it going to cost you, whether the expansion is even worth it. So that gives you an idea. So I am going to run through the components of a business forecast, and the first item of business is getting some assumptions out of the way. Let me just get this out of the way. So if you're a startup, we basically start by getting to know what assets you have to start out with: your operating capital, your sources of funding, and things like that. If you're an existing business, a lot of these things you already know because you're probably using QuickBooks to track all this stuff. So we may skip all this initially if you're an existing business and we're modeling. If you're not an existing business and you're building it from the ground up, which is my assumption, I'm going to go ahead and basically show you what you need to do. So we start off in modeling your business with payroll, and that's part of the income statement that we create. And first, we start with creating your income statement and its components. Then we move on to your cash flow statement and then your balance sheet. So I'm going to focus on all the components initially what you need to create your income statement. And we start out with payroll. So the things that we track in our model are, who the owner is, full-time employees, part-time employees, and things like that. The number of employees of each, how much they're getting paid, their work week, and then we come out with a basically pay per month based on detailed assumptions of, withholding expenses and benefits and things like that. So I should have mentioned this before we start the process. We actually go through a few days to a few weeks actually understanding the business by interviewing management, understanding competitors, what they're doing. We'll go in and actually spend time in the business and actually see how it's run so that we can get a better idea of how it's run, how efficient it runs, and what the expenses associated with it. And we also, if I didn't mention, interview senior management in the process. So after we do this for year one, and we do, by the way, payroll monthly until we come out with an annual forecast, we then make the same assumptions for years 1, 2, and 3. So we do a forecast for all 3 financial statements: income, cash flow, and balance sheet, for 1 to 3 year period. The first year we usually map out monthly, and then the next 2 either monthly or yearly. So in terms of the payroll, some people make the mistake of just assuming growth rates for their payroll. We don't do that exclusively. What we do is actually year 2 and 3, we actually track the exact number of headcount that you actually are planning to make. And then we make assumptions of what you're paying these people that you're bringing on, rather than just using a growth rate that a lot of people do and mistakenly do. That's why the forecasts are wrong. We use these growth rates for the existing employees because of inflation. Expenses tend to go up, and so we make assumptions in that respect. So after you do your payroll, we do sales forecast. A lot of mistakes businesses make is they arbitrarily assign cost of goods sold to units. We don't do that. We break down each SKU or product line within its cost components, and then assume the number of units sold in a given year and in a given month. So I'm going to go through very briefly the cost of goods sold calculator. And in this particular exercise, we actually go through how much it actually costs to make a number of products in a given month. And then we work backwards. So on what those components are. And the 3 major components are raw materials, labor, and the use of the factory. So those are the 3 major components that go into cost of goods sold, and all those are laid out here. And so we calculate that, for example, costs in a given month to make 100 units, X amount of raw materials, X amount of labor, and X amount of the production facilities used to actually for manufacturing. And then we come up with a cost of goods sold by unit. And we do that for each product, not just one product. We do it for each product in very detailed, so we understand your cost components, so that we can actually go in and maybe save you some money by understanding the components, and also better, I mentioned to you, the bidding process, where business owners don't understand, what the cost inputs are for a given job. We'll go in and actually help them do bidding because we know the cost components. Quite often people use an outside party to do that, and they have no idea what the expenses are for the bidding process. And they're actually, most bids are wrong. So anyway, after we do the cost of goods sold, we then go back to forecasting the number of units by month, by product line. So that's what these numbers are. And we do that for not only year 1, but year 2 and 3 as well. A lot of just assume for years 2 and 3 a growth rate. We don't do that, although we have an option to do that. If one doesn't have the time to actually do it, we don't recommend doing that, but we actually will go in an interview process, understand why a business owner wants or can grow at a certain rate, and then make a realistic assumption based on the business cycle of what the business can actually grow at, in detailed format, rather than just assuming an arbitrary growth rate. So after we do that, we make certain additional assumptions based on how quickly you're collecting receivables, how quickly you're dispersing your payables, and your credit line, if you have one, because they may actually supplement your negative cash flow, and any fixed additional assets you may be doing in the next years to come. And we map all that out. After we do that, we go into your operating expenses, and most importantly here, all these inputs usually come from your QuickBooks if you're an existing business. So I'll draw right into your QuickBooks. We usually do the past 2 years, and the prior year we usually do it on a monthly basis, and then we start forecasting year 1 going forward. What I should also add is, unlike others, we classify your expenses by variable or fixed. And that's what the V and F stand for, green and red. And why do we do that? Because it's very important to understand what costs are variable and what costs are fixed, because that determines how much leverage you have in the business, meaning how fast your margins can expand and a given revenue growth. So a lot of mistakes made in modeling a company is just by assuming a growth rate of expenses and not taking into account their relationship with sales. For example, if you have commissions and fees, the wrong thing to do is actually just assume a growth rate, say 5%, not knowing the commissions are directly tied, if your compensation is set up this way, to your sales. And so we'll get to understand what actually goes into these components to determine if they're variable, fixed, and how much they are tied to revenues. But suffice it to say, we don't just plug in growth rates, because we actually get to know your business brick by brick. So after you do your operating expenses, that all feeds into your income statement, which your revenues, your cost of goods sold is laid out, and then your operating expenses, your payroll. That's all. We just did that. We do that on a first year out monthly, and then we also do it quarterly, which I think this is a better representation of the business. A lot of people just break out all the components monthly, and a lot of people can't synthesize that in their brain because there's a lot of numbers involved. So we like to break down the, say, example, the operating expenses into 4 broad categories: G&A, selling, marketing, research and development, and depreciation and amortization. So you can get a better understanding of those broad general categories and how they relate to sales, so that I can compare your business to others. Because if you have if you just use the components of the income statement on operating expenses, you can't really compare apples to apples to other businesses. If you do it in this format, where the operating expenses are sort of in broader categories, you can actually make comparisons to other companies. That's something we do different than most other people. So after we do that for year 1, we do that for years 2 and 3, which are in this case 19 and 20. Then we go on to cash flows. I won't get into the details here, but the basic premise here is we're trying to calculate your operating cash flow and your net cash flow of the business. So the total amount of cash is either generated or lost, and how you're going to supplement that, whether that be through additional capital raises or credit drawdowns. And at the end of the day, we track how much cash you have, and that feeds into your balance sheet, cash flow wise, which I'll show you in a minute. And the balance sheet here has a cash line, which that line is derived from the cash flow statement, and we model the balance sheet for 3 years out. Probably one of the more value add things that we do is we do financial ratio analysis and break-even analysis of the business, and we actually, for a given level of sales, what your break-even point is, and we do that kind of analysis as well as ratio analysis. Basically, we look at the details of your business, how efficient it's run, how profitable it's run, the liquidity and things like that, so that we can summarize and track the business and compare it to other companies of similar size, so that we can better optimize the business. And that's basically it in a nutshell. So that concludes the tutorial. And again, I hope you get a sense of the 3 major components: the income statement, the cash flow statement, and balance sheet, and how we do it. It's pretty detailed, and we get to know your business in as we say, brick by brick, so that we can help you optimize it and make it more profitable and maximize the asset you have. So take care. That concludes our broadcast. Thanks.